Good day, Market Chameleons and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Demetri, or myself are registered investment advisors or a broker dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. One last look at the disclaimer. And let's welcome Demetri to the stage. How you doing, D?
Good morning, Will. How are you?
Great. So what are we looking at today? Understanding option implied volatility, lean in a bid-ask spread.
Yeah. So let me show you how to get to it, and then we'll just talk about implied volatility lean and what is it, and why it's important, how you could use it. So let's just I'm going to use Tesla in our example. I'm going to go to Tesla page by typing in the symbol here. This will take us to Tesla's main summary page. And on the left-hand side, go under options, click option chain. This will bring up Tesla option chain. I'm going to click on this side menu to minimize it, expand our screen. And what we'll do is look for what we refer to as an implied volatility lean in a bid-ask spread. And I'm going to scroll down here on Tesla. As you can see here, this is the option chain with the different expirations available on the left-hand side. If you click on that expiration to the right-hand side, it brings up an option chain with the call options, put options, here are the strikes. And next to it, you get the bid-ask prices for that option. Bid is where that's the best price right now displayed that's available to sell something on, and the ask is the best price somebody's willing to sell it at. And those are firm quotes, right? You call them firm bid-ask, because if they're displayed, that means that if you sell it on the bid, then you will get the other side who's displaying that bid is obligated to buy it. The seller is obligated to sell it as long as that offer is displayed. So, and a question came up, that I wanted to this is why I'm talking about the implied volatility skew, is that there's an assumption, well, if there's a trade on a bid that is implying, well, there's a market maker bidding for something, and then somebody sold an option on the bid to the market maker. And the same thing if you see a trade that got executed on an ask price, well, then the assumption will be, well, that was a market maker or specialist offer, and somebody bought it from the specialist. And a lot of times that could be true, but not always, because when we look at the bid-ask prices, let's just say here on the 320, right? The 320 call, the bid is $5.15. The ask is $5.25. That quote, okay, that bid-ask quote, it is made up of market makers who are streaming, for sure, specialists, but it also includes bids and offers that are placed by retail customers. It could be streaming bid or offer that's pegged to some implied volatility. It could be, just a resting order there. So you put in a limit order, and if the market moves, if you're the best bidder or the offer, it'll get displayed. Okay, so when retail customers put in a bid, a limit bid that's not automatically executed, but if it's the best bid, it'll get displayed. It'll look at you, to you, if we're looking at it from here, it'll look like any other quote. You won't be able to tell the difference if it's a market maker or not a market maker. It'll just look like a displayed bid or offer. Okay, so those markets that we're looking at, those are made up of, all the market participants, market makers, retail customers, even professional traders. That creates what we call the NBBO, National Best Bid and Offer. So when we look at that, well, sometimes what will happen is that you could have market makers. So the market makers, right, they're trying to provide liquidity to based on what they think the values of that option, and they create a spread around that value. So they call that their edge. So if they think something is worth, over here, like say $5.20, well, then they might be willing to pay $5.15 or sell it at $5.25 because they think that, well, there's 5 cents edge. But they could get it for 5 cents cheaper or sell it for 5 cents more. Or these could be made up of different market makers. Maybe one market maker is willing to buy for $5.15 because they think it's worth $5.30. In this market, there's a different market maker, let's say market maker B, is willing to sell it for $5.25 because they think it could be worth $5. So these are competitive quotes. Okay, these quotes, these bids and offers, they're competitive and could be made up of a lot of different market participants. And when you're trying to accomplish something, let's say you're trying to buy an option, well, sometimes what you will do is give an indication to the market, right? So how do you signal to the market, hey, if anybody out there is willing to sell this option, I'm willing to buy it and pay a little bit more, right? So I'm willing to step up and be the best bid or the best offer. And so you do that by placing in an order, right? And by placing in an order, you could squeeze the market right to one side. If you're trying to buy, you're gonna step up and be the highest bid. Maybe not pay the offer, but be the highest bid, because if any order comes in to sell, you want to be the first one to be on the buy side. And to detect that, there's certain ways that you could possibly detect that, and that's called an implied volatility lean. And here, these implied volatility leans are in the white. Okay, so these are white highlighted implied volatility leans. So you could see here, we have this white highlight, 40.4, and on the bid. So you see here, this is the bid implied volatility. This is the ask. And what we're seeing here is that the bid, right, is detected, is displaying that somebody there, it's either a resting order or somebody's trying to step up. It could be a streaming implied volatility pump. Somebody's indicating that they want to squeeze the market from the buy side. Okay. And that could create an opportunity for somebody trying to sell, because now you have this indication, hey, I'm willing to step up. If you're looking to sell an option around these strikes, I'm looking to buy this one. And we could kind of tell just by looking at it, this highlighted pointed it out, but we could tell, kind of by looking at it that, it's 5 cents wide, this one is 10 cents wide above here. This one's 10 cents wide. So it did close up a little bit, the bid-ask spread relative to some of these other ones surrounding it. This is 10 cents, this is 10 cents, this is 10 cents, here's 5 cents wide. So it's a narrower bid-ask. And by looking at the implied volatilities and the surrounding data, this looks like it's an implied volatility leaning to the buy side. So look how these implied vols look. If we look at it, they go from 40.7 to 40.3 down. This one comes back up 40.4, then down 40.1, 40. So you could see here, if if you did a smoothed out curve, you know, this would be somewhere between 40.3 and 40.1. It would just kind of, you know, slope smoothly down as your, you know, the smile theoretically would be smoothed out, not jagged, but this one's jagged. So this one is indicating, hey, it looks like there is a potential buyer there, right? So the aggressive, so this looks like there's an aggressive buyer. So even if it sells something trades at 905, it looks like it's because there's somebody, you know, trying to squeeze the market from the buy side. Okay. Kind of similar to here. So look at, you know, this one, here's a market 20.77, 20.79. But you could see here that how the implied vols move from 40.3 up to 41.3, then back down to 41.2, which is indicating something there is jagged and has a lean towards the buy side. Okay, it doesn't always have to be from the buy side. Here's some, let's see if there's any, you know, obvious sells here. I mean, there's a few here in the smaller ones, but what we could do is say, okay, now that we kind of understand it, maybe we're looking for something in a particular expiration. So we could kind of come down here, and this table up here, I'm going to close it. This is over here, option IV leans, kind of gives us a quick summary of the leans in the option chain. Okay, so when we click on it, we have two kind of tables. The first table up here shows us the option with a lean and has volume traded in it. Okay, so the July 18th 317.5 call, 47,000 contracts traded in this particular option, and we detected a lean on the bid with the price of 630. Okay, so July 18th, 317.5 call. Here it is. So this is July 18th, 317.5 call. You see here we detected a bid lean, 40.2. Okay, and according to this, we detected that 47,000 contracts. Okay, so almost 47. This is rounded, traded in this particular option. So this is saying that there's quite a bit of volume in it, right? It's trading a lot, and there's a lean in there that looks like a lean. So it's trading a lot with an opportunity for price improvements. Okay, this is pointing to trading interest with price improvements, and it's telling us right now it's on the bid side. Okay, same thing, July 18th or 312.5 call. That's the next one, 19,000 contracts. There's a lean on the bid side for 905, and these are the top five. Then it drops off. Here's July 18th. Also to the bid, 5,000 contracts, a lean on the bid, 9.5. Here's the leap, January 16th, 2026. We could take a look at that, click on that. So this, you could see 130 trading days out, 186 days. So what was it? It was the January 300 call. There's a lean on the ask side. So over here, we could see here's a 300 call. There's a lean on the ask side, 60.15 and 7,700 contracts traded in there. You know, we could even like open it up and see what traded. But this gives us a quick way. These are all the trades in there. You know, VWAP price 53.69. So what this is allowing us to do is quickly kind of scan and understand the markets and what's going on, what's trading, you know, which way people are leaning currently, in case we're looking for an opportunity. If you're looking for an opportunity to say, hey, maybe there's somebody right now willing to sell an option for an improved price, right? There's a lean, improved price, and there's people willing to trade on it. That could be an opportunity. Other people think that is a good, there's two sides who think it's good, but obviously you have a chance for price improvement. These are the top 5 with volume, but without volume, you could have leans, and this points out for each expiration how many leans, different options have leans on the bid and how many on the ask. Okay, these are in the calls and then in the puts. So let's say July 25. We'll go to the next month. The calls, there are 10 different options that have a lean on the bid. There are 7 options that have a lean on the ask. In the puts, there are 12 options that have a lean on the bid and 9 on the ask. So let's say I'm looking to buy a put. Well, there are 9 of them here that have a lean on the ask. So we could click on that, July 25, and scan and be like, okay, here's one. Here's another. So these are in the money. Here's one, the 29 delta. There's a lean on the 670 put. Here's one, a lean in the 200 put, at $4. So one's at 4, one's at 670. So these look like a relatively, right, if we're looking at implied volatility, a relatively cheaper implied vol than the surrounding options. If you want to look to sell an option, here's a lean on the bid. There's a lean on the bid. Okay, so this is a quick way to get price improvement, find potential opportunities, and also combine that with there's other people, participating in those trades and transactions. Well, I'm going to stop there. That was a quick overview of that tool.
Yeah, that was great, D. The Chameleon community was very grateful for that. Thanks for bringing these daily tutorials to the Chameleon community. You have a great day, my friend. We'll see you tomorrow.
Thanks, everyone. Stay safe out there and have a great trading day.
All right, we'll see you tomorrow, buddy. Everyone, thanks for joining another tutorial episode with Market Chameleon and Demetri. Check out check out yesterday's webinar with Ryan if you get a chance. He is from Options Robot, and he was using Market Chameleon and Options Robot, which was kind of cool. We did that after the close. We're going to try to do maybe one of those a week where he looks for some different ideas on the Chameleon and then uses Options Robot to put them into the marketplace. Everyone remember to follow us on all the social platforms. Thumbs up, like Jim says, greatly appreciated. Thanks for that information, Chuck. I am wondering if I can get a trainer to maybe solve some issues with a 1-year-old that we just rescued. But anyways, everyone have a great day. Thanks for joining. We will see you tomorrow, hopefully.